Hey gang, Adam Von Romer here, author, speaker, seminar leader, 32-year veteran of the Commercial Investment Real Estate Academy, or Real Estate Arena, and founder of the Commercial Investment Real Estate Academy. Hey, just out of curiosity, somebody let me know if you can hear me loud and clear. I'm showing 4 bells on my end. And let's get started, shall we? So I hope you're all looking at what I'm looking at, the Commercial Investment Real Estate Academy internal rate of return and why it's the best investment measure ever. And I want to let you guys know the reason I think that is because, like we talked about in the previous sessions when we started with the cap rate, the gross rent multiplier, and the gross income multiplier, what we discussed was they all had limitations. They were all either for very short periods of time, or they were for like a year, or they just didn't take into consideration everything that we really need to deal with when we're thinking about commercial investments. So I think we needed something a little bit better. And I'll tell you, I was kicking around looking for a place to find a good, solid definition of the internal rate of return. And I found this one on Investopedia. I thought this was great. It's the metric used in capital budgeting, measuring the profitability of potential investments. The internal rate of return is a discount rate that makes the net present value of all cash flows from a particular project equal to 0. IRR calculations rely on the same formula as NPV does. Well, if that doesn't clear it up, I don't know what does. I got to tell you something. I think that's a little bit cumbersome, and I think we can do better. And for those of you who know me, you know I'm kind of like the ultimate reductionist, so here goes. I'm going to give you my definition. And basically what I got to say is the internal rate of return measures the rate of return on your invested dollars while they remain in the investment. And I think that's probably about the best definition I've heard and the best definition I can share with you. So what we're doing is we're now, instead of looking at a snapshot in time like a cap rate or the cash on cash return or the gross rent multiplier or the gross income multiplier, we're going to start to consider time, because most owners own a building over a period of time. They don't own it for the last day of the year. And because we're dealing with cash flows, and we talked about this before, where the piece of real estate's along for the ride, and what we're really trading is an annuity. Occasionally the rents go up over time. And then finally, we're going to think about selling that asset at some point in the future. And we're going to have some reversion to deal with in our investment. So that's what we're going to be comparing and contrasting and see how that stacks up with what our expectations are. Now, the other thing is, I've got to remind you guys that when we started this adventure, we started looking at gross rent multiplier, gross income multiplier, and cap rates. And those are all over in YouTube for you to take a look at. We did the cash on cash return, and what we found out as we moved forward was we went in a gross income multiplier or gross rent multiplier, and we had a return of 10 or a multiple of 10 or a return of or a multiple of 120. Then we did the cap rate, and we came up with a 10% return, and then we went and borrowed some money. Well, we're going to try and carry on in that vein and use pretty much the same numbers. But what I'm going to do this time is I'm going to show you the straight cash flows, and then I'm going to show you the after debt service cash flows, and watch what happens. The other thing you'll recall is we started at a 10% cap rate, but because of the judicial use of leverage, we ended up with a slightly higher yield in our cash on cash return. Well, our yield's going to go up even more because we're getting the benefit of increasing rents, and we're getting the benefit of that big cash kicker at the end when we sell the asset. So the other tool we're going to need, remember our buddy the T-bar? That's how we're going to tee up our problem. And then what we've got to do is really kind of discuss the nature of the problem. Now, don't freak out. We're going to use the same cash flow journals we've done before, and I'm going to show you the keystrokes on our trusty HP10B2. I'm going to throw that up here on the screen in a minute. But here's the setup. We're going to buy this investment for $1 million, and we're going to buy it at a going-in cap rate of 10%, which means we're going to have a cash flow or NOI of $100,000. But in this case, what we're saying is we're going to sell the building, or I'm sorry, we're going to get a 3% annual increase in our leases, and we're going to sell the building at the end of year 10. But typically the way we do that is we're going to cap year 11's income and use that for our sales price. So we're going to buy the building today for $1 million. That's our going in cap rate of 10%. We're going to get $100,000 a year starting in year 1. That's going to go up 3% a year each and every year for the next 10 years. And then what we're going to do is we're going to sell the building at the end of year 10, but we're going to use time period 0 of year 11, the first month, first annualized payment, if you will, of year 11 to capitalize and sell our building. Now, the other thing you got to keep in mind is, and I want you to really think about this, is our cap rate that we're going to use for our reversion going to be higher or lower than our going in cap rate? And the answer to that question is we're going to use a higher cap rate because our building's not getting any bigger, better, or sexier as it gets older. In fact, if anything, we're looking at capital improvements, and what we're going to see is that building starts to go down in value over time because of capital improvements. And I mean relative to the income stream. It may actually be going up in value, let's say, pari pursuit of the market, but our income and our reversion is probably going to go down because our cap rate's going up. And remember, we talked about that. If we have a fixed income and the rate goes down, i.e. the cap rate in the market goes down, consequently the value goes up and vice versa. If the rate goes from 10 to 12, we see the value of the property on the other end of our financial seesaw, if you will, go down. So let's take a look at how this kind of shapes up. And this is the final piece of the puzzle. So our year 10's NOI, and I'm going to show you this in a minute, is $130,000. In fact, it's $130,477. And we're going to divide that by our terminal cap rate of 12%. Now, in our cash transaction, we're going to pay $1 million. We're going to get the cash flows. And then when we sell at the end of the time period, we're going to get that reversion. But also in year 10, we're getting that cash flow of $130,477. So we're actually going to get $1.3 million back at that time of sale. I hope that makes a little bit of sense. So let me show you how it looks on the T-bar here so you can kind of follow along with me. So our initial investment, and we're doing just the cash version right now, is $1 million. We're going to pay $1 million for this thing, and that goes in at time period 0. You see that right here? And that's the same as day 1 of the first year or whatever. At the end of year 1, we're going to get $100,000, and then we have our escalations of 3% a year. See, year 2 is $103,000, year 3 is $106,990, year 4, year 5, year 6, etc. They keep going up 3% a year over the prior year. So that looks pretty much about what like a lease looks like in real life. And if you're not quite following me, here's the setup. We're going to have $130,000 in our terminal year, year 10, plus we're going to sell the building for $1,186,000 for a total terminal cash flow of $1,316,632. So we've got a pretty nice chunk of change in that final year, and there's where we put it, right there on the bottom line at year 10. So what we're going to do is we're going to measure what our yield is for this stack. You know what, Carol, I misspoke. I'm using year 10 for that reversion. Thanks for pointing that out for me. The question was, I thought you were using year 11, and I'm not. I'm actually using year 10. So, oops, thanks for pointing that out. My bad. But at the end of the day, what are we going to get? We're going to get $1.3 million for our cash flow in that final year. So let's whip out our handy-dandy HP 10V2 and tee that one up. In fact, there's our buddy right now. Let's go ahead. First step in this process is to clear all, so we'll get rid of all that. And remember, we got to make sure we're in the 1 payment per year mode. And there we have it, because we're calculating annualized cash flows. So our first cash flow is what? Remember, it's $1 million, right? But because we're paying it, what do we have to remember to do? We got to do the change sign first. And where are we going to put it? We're going to put it in our cash flow. Remember, we're using the cash flow journals for all of those uneven cash flows. If we had even cash flows, we could use the register at the top. But because they're different cash flows, or there's a cash flow differential, we're going to use our cash flow journal. So we're going to go ahead and put our initial investment in here of $1 million, and that went into the cash flow zero journal. Now, what's our next cash flow? And let me do this. Let me go back one page so I can read it myself. All right, let's get our calculator back up here. Voila, there's our handy dandy HP 10B2. So our next cash flow is cash flow 1, and that's $100,000. And because we're getting it, that's positive. So let me go ahead and pop that in there. And that went right in our journal. Our next cash flow is $103,000. And pop that in our cash flow. The next cash flow, year 3, is 106,090. Our next cash flow is 109,273. See if I got that right. Yeah. Next cash flow is 112,551. 115, and you all see where I'm getting that. I'm pulling that right off of our T-bar right here. And you can see the importance of what I said about, whipping up that T-bar, because it keeps you kind of in line and on track for teeing up the problem. Cash flow 7 is 119,405. Cash flow 8 is 122,987. Again, you see where I'm getting that right here. Cash flow 9 is 126,677. Put it in our cash flow journal. And then our terminal cash flow in year 10 is 1,316,632. Let's see if I did this right. Cash flow 10. So now we've loaded all of our cash flows in our handy dandy HP 10B2, and the only question that we have left is what's the yield? What's our return on investment? And how do we do that? Well, again, remember, we look at our keys, and right there you see the gold key in the middle under the CST button. That tells us our internal rate of return per year. And because it's in gold, what do we have to do? We've got to hit our enunciator. So we're going to juice that up, hit the enunciator. And if I did everything right, we should get our yield. And according to that, our yield is 12.20%. Now, we bought at a 10 cap, but we're getting a 12% yield on our income. Now, why is that slightly lower than a 3% annual increase? Because of our reversion. We didn't have that much reversion at the end. And remember the power of discounting. We said we got to wait a long time to get it. And this was a straight cash in, cash out deal. So if we were investors, we might be willing to accept a 12% yield. But remember, in this case, this is a 12% yield pre-tax. So it's not bad. But I think there's something a little bit more exciting waiting for us here. So let me go ahead and get rid of our buddy here, the HP 10B2, and let's carry on with our slide presentation. Now, what I'm going to do in the next slide is we're going to talk about what happened. We started with a 10 cap going in, and we got a higher return. Well, how did we get that higher return? We got that higher return because we had annualized increases of 3%. But why didn't it quite make a 3% yield? Because we had to wait to get them over time. So we still had a little appreciation, but we also had that deflation, if you will, that little future money Pac-Man nibbling away at our money, especially the later years. We did get rental increases, and we benefited from those during our hold period, but they weren't stupendous. We also got a higher reversion that was slightly higher than what we paid for it, but it wasn't exactly exciting. So we could probably do better. And the other thing is we benefited slightly from time. Remember, I said that was one of the main limitations with the cash-on-cash return or the cap rate. All you're really looking at is the last day of the first year, and it doesn't take into consideration anything to do with the future. And we talked a little bit about that in our prior session. The other thing is the internal rate of return can be calculated either pre-tax or post-tax. And it's real difficult to do something like that with a cap rate or a cash-on-cash return because you're not taking out the tax benefits. You haven't gotten that far down in the stack. The other thing is, oftentimes, if not almost always, the internal rate of return is going to be calculated using the debt service. And let's take a look at what that looks like. I'm going to show you our next problem here. Now, in our previous example, we bought it for $1 million. We put $250,000 down, and this was from our cash-on-cash workshop. But we said we also had an additional $20,000 in acquisition costs, points, fees, whatever. So our all-in initial investment was $270,000. Now, we had $50,000 in year one because we were basically paying interest only on our loan. So remember, here's our mortgage. We still owe $750,000. And at the end of the day, we're going to have to take care of that. So what happens is we're going to take our initial investment. This is our cash now. This is the cash flow that comes out. It's increasing 3% a year. And then just like the prior example, what I did was I put it in and said, okay, we're going to cap our cash flow. Our sales proceeds were $1,186,000, but we still owed $750,000 because it was an interest rate only mortgage. So what we had to do was subtract out our interest only mortgage. We had to subtract out our debt service, and our net cash in this case was $436,155. So $436,155 plus our $65,000 cash flow gives us this $501. So it's changed slightly, even though it's the same investment, and we're looking at this basically from a post-debt service position. Now, let's do this. Let's get our buddy, the HP 10B2, up here again. And what's the cardinal rule? We're going to go ahead and clear all. Hey, gang, remember, if you got any questions or comments, put them in the chat box on the left, or I'm sorry, on the lower right side of the screen so I can see them. I saw that a couple of comments were popped in there. Anyhow, take a look at our calculator. We're going to go ahead and clear all to make sure we're not carrying anything forward from the last problem. I'm going to go ahead and put our initial investment again in. But remember, what do we got to do? We've got to change it to a negative because it's cash that flowed out of our pockets, right? We wrote a check at closing for $270,000. So we're going to change that, and that's our first cash flow. Cash flow is 0. Our first in our pockets cash flow is that $50,000 from year one. So that's our net operating income minus our debt service. In other words, that was our cash throw-off. So that's our first year's cash throw-off. $51,500 is year 2. $53,045 year 3. $54,636 is year 4. $56,275 is year 5. $57,964 is year 6. I got that right. $59,703 is year 7. I haven't made a mistake yet. Hold on. It's coming. I feel it. $63,339. Whoops. Got to put another 3 in there. And then our terminal cash flow, 501, $393 for year 10. What did I do? Yikes! Did I put something in twice? I knew it. It was going along too good to be true. Hey, Lorena has a question. She says, how do we know for sure that your return is going to be more than the initial 10%? We don't. And in fact, that's what we're trying to prove here. But if we think about it, if we've got the judicial use of leverage going for us, theoretically, if our rate of our leverage, our cost of capital, is lower than the cap rate, we should have what? We should have positive leverage. But here's how we're going to prove it. We're going to go ahead and tee up our problem and solve and see what it comes up with. So let's see if we got this right this time. I talked too soon. I knew something was coming. That's the only problem with these blasted calculators, is having to put this stuff in. Now, for you guys that have the HP 10B2 on your phone, you should be good to go because it does all this. It graphs it out for you and everything. 59703. Jason's saying year 5. Year 5 what? What'd I do? Did I make another mistake? 61494. Uh-oh. The other thing is sometimes you can hit buttons on this emulator and it doesn't quite do what you want it to. But it's probably one of the best tools I have for showing that. All right. So now we've got all our cash flows in there. Now remember, this is cash flow on our cash, not overall investment. We're looking at that cash on cash return, but we're now taking out our debt service, and this is our yield on our money. This is what we get to put in our pocket. So let's see what happened here. Voila. We got a 22.37% return on our money using leverage. Now, a couple of things happened here. If you remember, and if you don't remember, you can always go back and look at our cash on cash return. Because the way we bought the building, our cash on cash return in our first example was about 18%. Now, we've got a 22.3% yield, but remember that 22.3% yield not only constitutes a return on our money, but remember, because we use some borrowed capital, we're getting a yield on the borrowed capital as well. Now, the question I have for you at the end of this whole presentation, if you will, is can you see why I tell you that cap rate and cash on cash return, gross rent multiplier, and gross income multipliers are pretty much doo-doo? They don't give you a real picture of what's going to happen in that property over the next several years or over that ownership period. And I want you to think in terms of when somebody buys a piece of property, do you think they might want to know what it's going to be worth to them in years 3, 4, 5, and 6? And when the optimal time to actually sell the property is? I think that's a pretty valuable tool for them to take a look at. So what happened here? This was our cash into the deal. This was our cash out of the deal. This was our net cash flow. Remember from our example over here, we sold it for 1.1 based on our NOI, capped at 12%. Subtracted out our $750,000 mortgage. There's our net cash flow. That's in our pocket. Added to it our net cash flow for year 10's rents, and voila, that put us in that 22% range. Now, Mario says leverage rocks. Well, we saw that in the, is leverage good or bad module, that leverage is good or it's bad. It depends on how you use it. The key here was, what are we looking for? We're looking for judicial leverage. So follow me here. We started out with a 10% cap rate. That wasn't bad. And then we took the same investment, we applied some leverage, and by the judicious use of leverage, our yield went to about 18%. But now, because we've held it over time, and actually sold the property, which is, you know, the layman's term for reversion, we got a 22% yield. Now, I don't know about you, but 22 is a whole lot better than 12 in my book, and certainly a whole lot better than 10. And I think this gives you an idea and certainly an indication as to a better way to look at properties, and certainly maybe a better way to offer properties for sale if you can articulate to the seller their true yield in this overall investment. And I hope that makes some sense for you, because I think when you look at some of these investments, you know, you see, oh, it's only a 6 cap. Well, it's a 6 cap, but what happens in the deal? What happens in years 3, 4, 5, and 6? And are we applying leverage? And are we getting leverage at such a rate that we're actually making money on our investment? So that's the internal rate of return. Now, the only other one that's even better than that, and we're not going to do that because that's well beyond the scope of what we're going to encounter, is called financial management rate of return. And that's something you'll learn in the CCIM program. And what will happen is you'll take all of these cash flows and you'll discount all of these cash flows back to time period 0 as if they were the initial investment, and compound, or I'm sorry, all of the discount, all the negative cash flows get discounted back to time period 0 as if it was being invested in day 1. All the positive cash flows get compounded forward, and then you end up eliminating everything in the middle. But what it gives you is a rate of return based on your ability to pull that cash flow out and reinvent it. Osvaldo says it's all about leverage. Well, it is. It's about judicious leverage. Not just leverage, but the right kind of leverage. And the other thing I want to really stress here, gang, is it's about timing. It's about timing. The typical real estate cycle is 7 to 10 years. Mortgages today are cast for 30, but amortized in 7 to 10. If you were an owner, when would you think about selling this building? Yeah, probably right around year 7 to 10, because if you looked at it and graphed it, you've got a bell curve here where you've got income, you've got appreciation, and as you start to go past that 7 to 10 year mark, you're going to start talking about capital improvements. You're going to start talking about things like functional obsolescence and physical obsolescence. And my theory is make that somebody else's problem, take your cash, and in this case, do my personal favorite, 1031 into another building, bury the capital gains tax, bury the, the recovery, the cost recovery tax, and keep moving. So that's my theory on all that. Now, guys, there's our buddy, the HP 10B2. I gave you the keystrokes for it. Now, that's the end of our module here on the, net present value and internal rates of return. Again, if you have any questions or comments, obviously, guys, go ahead and email me. I certainly welcome it. Let me put this back up here for you to take a look at. Not the calculator, of course, but our little problem on the T-bar. Remember, the T-bar is your new best friend. Whenever you're going to encounter something like this, lay it out on the T-bar first. Don't rely on your mind, because if you're anything like me, chances are your mind's derailed, or maybe some of your medical marijuana's caught up with you. But I want you to understand, this is probably going to become your new best friend. And I got to tell you guys, if you've been listening and paying attention, I showed you how to get that APOD that Gary Tharp, the eminent CCIM, created. And I don't care who you talk to, I think that's the best thing that's been presented in the last 25 years. It's simple, it's easy to use, and you know what? It gives you the internal rates of return right there in the sheet. So when you're talking to a potential investor, you say, hey, listen, let me tell you why cap rates doo-doo. And no, don't tell them it's because I said it. Tell them that cap rates are doo-doo because they're only good for the last day of that year. Show them the internal rate of return and let them know what the property's really going to do for them. Remember, what are they buying? They're buying the cash flows. They're buying that annuity, and the real estate's just along for the ride. So again, guys, I hope that helped kind of clarify that for you. And as we move through this series, I'm sure somebody's going to have a lot of questions on how to apply this And what I'm going to do, I'll circle back to you later on with maybe some additional information and maybe show you one that I'm looking at in real time so you can see how I look at the property and go, ah, that's what he's talking about. As always, if you've got any questions or comments, let me put up my contact information here. Right there. Oops, no, it's not right there. Well, you guys can reach out to me at avonromer@outlook.com. And let me pop that right in our little chat box here. I'll pop that in so you can reach out to me. Also, if you need to, I'll give you my office line. And feel free to give me a call. Love to talk to you. Questions, comments, concerns about internal rates of return, feel free to reach out to me. I hope you guys got as much out of that as I did. I certainly had fun. It's riveting. And if you've got anything else you need to know about commercial investment real estate, just give me a ring. Love to talk to you about it. Hey, thanks again, guys, for all your time. Uh-oh, Oswaldo, can we get the video? I don't know. What do you think? Should I make the video available on YouTube? Any votes for that? Let me see a show of hands. All right, I'll do it. If you guys say please, I'll put it up. I'll sanitize it and clean up the ums and ahs. Oh, Lorena says no. Okay, you don't want me to coach anybody. Listen, I'll clean it up probably over the weekend and get that up for you. But remember, listen, guys, get back on YouTube. Look at that cash-on-cash return we talked about, because that's kind of the basis of this whole module here. And if you didn't see that, hit the cap rate. You know, the cap rate revealed, and then just kind of walk through those, and you'll see how the yield keeps going. All right? Again, thanks for joining me. Hope you got something out of it, and I'll see you all later. Have a great night.